Welcome back to the deep dive. Today, we're really going to dig into tokenized stocks. They sound pretty revolutionary, right? Instant trades, access for everyone, everywhere. But, like always, there's more under the hood. And in this deep dive, we're going to uncover some, let's say, crucial details and maybe hidden catches you absolutely need to know about. We've gone through a ton of material analyses, issuer docs, the works, and our mission today. Simple. To pull out the most important stuff so you know what's what in this fast-moving space.
Yeah, it's fascinating because tokenized stocks, they're not just a small tweak. They're really challenging how we even think about owning assets, about accessing markets. They basically represent real shares,
Yeah.
but they live on a blockchain. And that hints at, well, a future that could be way more efficient and genuinely global.
Okay, so let's break it down. Basics first. What are tokenized stocks, really? How do they actually, work?
Right. So at their heart, they're digital tokens. Think of them like entries in a digital ledger, the blockchain. And crucially, many of them are set up to be backed one-to-one by the actual traditional shares, the paper certificates or digital records held somewhere safe, usually by a regulated third party, a custodian. And this setup enables something pretty cool, fractional ownership.
Fractional ownership. Okay, so I don't need to buy a whole expensive share.
Exactly. You could buy, say, $50 of Google, even if one share costs, thousands, makes things much more accessible. And the buying and selling, that's handled by smart contracts.
Smart contracts,
Yep.
like self-executing code.
Pretty much. They're coded onto the blockchain to automatically handle the transaction rules. No need for as many middlemen, like a digital handshake that enforces itself.
Got it. So that's the how. But why should you, the investor, care? What are the really big advantages here? What makes this exciting?
Oh, the advantages are potentially huge. Really transformative stuff. Maybe the biggest eye-opener is how they just cut through layers of old finance. First, efficiency. We're talking settlement in like seconds or minutes.
Seconds, compared to the usual T plus 2 days.
Right. It's a massive change from the 2-day plus waiting period we've had for decades in traditional markets. It saves time, sure, but it also cuts costs and reduces risk. Could even open up new trading strategies, especially for bigger players. Second big win, global access, democratization, really. Blockchain doesn't care about borders. So someone in, say, Brazil could potentially buy into a top U.S. tech stock pretty easily.
Interesting. Open things right up.
It does. Makes investing possible in things that were basically off limits before, a more inclusive system. And third, 24/7 trading. Stock markets close right. These don't have to. You get that continuous flexibility reacting to news whenever it happens.
Okay, that efficiency, the global reach, the always-on trading. It sounds almost too good to be true, which usually means there's a but. What are the risks, the tricky parts we need to be aware of?
Absolutely. There's always a flip side. The biggest issue right now, regulatory uncertainty. It's a major hurdle. The rules are different everywhere, and they're still being figured out. It's fragmented.
Which is why some companies focus on the EU, maybe.
Exactly. You see firms like Robinhood, Gemini, often starting there because the U.S. rules might be stricter or just less clear. And this uncertainty definitely makes the big institutional money hesitant. They need clarity before they jump in big time.
Okay, regulation is one thing, but you mentioned earlier, what do you actually own? This derivative disguise thing sounds important.
It is. This is probably the most critical distinction for you to grasp. There's a huge difference between different types of tokens. On one hand, you have fully backed tokens. Think back Finance's X stocks. They're designed so each token represents a direct claim on one actual share held in custody. That's closer to direct ownership.
Okay, like a digital claim ticket for a real share.
Right. But then many others are actually synthetic or derivative tokens. These just track the price of the stock. They go up when Apple goes up, down when it goes down. But crucially, they don't give you ownership rights in the actual company.
So you don't get voting rights or dividends directly.
Generally, no. You're buying something that mimics the price, not the share itself. Gemini's D shares, for instance, they explicitly call them digital derivatives. Kraken says flat out, token holders don't directly own the underlying stocks. Oh, remember that Robinhood OpenAI situation? That was about indirect exposure, not buying actual shares in OpenAI. It's a key difference.
Wow, okay, so tokenized stock doesn't always mean stock. You have to look closely. What about liquidity? If I can trade 24/7, can I always find a buyer or seller easily?
Ah, another nuance. Liquidity. Especially in these early days, it can be thin, really thin. We saw one example, a token for Apple, AAPL. It only had $195 worth of orders before the price would slip 2%.
Only $195. So trying to sell even a small amount could really move the price against you.
Exactly. That's called slippage. So the 247 trading promise, it can be a bit of an illusion if there's no one actually there to trade with, or if the underlying asset settlement is still tied to traditional market hours. And that leads to a sort of custody paradox. The tokens are on a decentralized blockchain, right? That's the appeal. But the actual shares backing them, they still need to be held somewhere safe, often by a centralized regulated custodian. Companies like Denari play this role.
Hmm. So decentralized tech relying on centralized trust for the real asset.
Precisely. It's this tension between the decentralized dream and the realities of regulation and holding real-world assets. Quite the balancing act, isn't it?
It really is. This has been super illuminating. We've seen the huge potential, but also these really critical distinctions.
Yeah, and if you zoom out, the whole tokenized stock story kind of shows this core tension, right? You've got innovation pushing for access, pushing boundaries, and then you have the need for strong rules, for clarity, for investor protection. Finding that balance is key.
So the big takeaway for you listening, as blockchain keeps weaving its way into finance, you absolutely have to understand the difference between real ownership and just getting price exposure. It's maybe the most important question to ask before you dive in. What do I really own here? Definitely something to think about.